Hey traders, Victoria from TRADEPRO Academy, and I hope everyone is doing well. In today's video, as you might have guessed from the title, we are going to be breaking down as to why support and resistance lines will never work unless you have this one specific secret that will help you understand as to where they come from and what they are. It's oftentimes that you draw trend lines or horizontal support resistance areas, whatever it is, based on price action, and you expect prior lows, prior highs, whatever the case may be, to actually hold out when price comes back into them. Now, a lot of people just base it on the price action where you saw multiple rejections. Maybe it's something like a supply-demand zone, but you don't really understand as to where and why these support resistance areas could or could not hold. The reality of the situation is if you use price action to draw your support resistance areas and only price action, you're going to see a very small chance of success overall. Now, I'm going to present to you guys with a tool that you've probably seen littered throughout our YouTube page as to how to properly identify support resistance areas and what you could base them off of. So after this introduction, we are going to jump right into the screens and I'm going to show you guys what exactly I'm talking about. So if you guys are excited but unfamiliar as to what I'm going to show you, just stick around and you guys will see that in action. So I'll see you guys later. Hello, we are back on the screen here and we're going to be breaking down as to why just going through straight up price action and your technical analysis on a screen isn't the best way to go about finding key support resistance areas, but mainly just trade areas where you want to trade. So there's the basic concepts of just general support resistance, like horizontal support resistance and trend lines, that is based on price action that a lot of people do follow, where you'll find areas that are tops and bottoms or whatever the case is, and they'll just go based on that, based on price action. Now, there's no necessarily high probability chance that you'll actually hold these areas time in and time out based on just price action, right? Whether you draw trend lines or just horizontal support resistances. And I'm going to show you how you can actually strengthen those areas where you can actually either mix price action and what I'll be talking about, or you can just completely abandon price action, go along with what we're going to be breaking down today. So for example, like you could be picking out some bottoms and tops and key areas. Like, for example, like if this prior bottom here, we can try to find where the exact bottom is. This is a daily chart on the S&P 500. We can say like 73. Now, obviously, to some degree, that area will hold. You can see right here below that, we drop actually 23 points, which is about $1,150 of risk per contract on the S&P. So these areas, right, this is a daily chart. So I'm not necessarily going to be trading off a daily chart, but you can use these very strong areas of price action to determine areas that you can day trade, right? This is going to be based on a day trade basis. However, the probability that these areas hold to a certain degree is just a little more minimized because you can see there are large dips below or above some of these key areas based on the actual price action itself, right? For example, like if we come into this area right here, this is a prior massive rejection based on price action. We put a resistance point somewhere here, right? So this area doesn't necessarily fail. We actually gap up and try to hold it. If we put a resistance somewhere here, right, it does hold to some certain degrees, but then again, you're kind of missing out on the general I would say precision of the move. So price action, it can have a place, but I think that in terms of precision, it's not going to work without one key driver. So the main key driver of the market, as we know, is going to be based on volume and order flow, especially for the futures market. Volume is what dictates price movement. So if there's a way that we could actually use volume as a cohesive tool in terms of finding our key support resistance areas, then we can actually solidify a plan that's a lot more precise, has a higher probability of actually trading and holding. So the main drivers, right, are going to be volume and price. When we look at futures, the futures market is perfect for this because it allows us to identify a very centralized exchange where all of the orders flow in and all of the data, all the volume is just presented on just one main plane, right? If we look at a depth of market, it's all going to be right there in the depth of market. All the orders are going to be going through that area. Now, when we look at this, right? We have to understand how the market generally moves. So before we dive into all this nitty and gritty, I'm going to be explaining just a few main concepts that will give you a better understanding of how and why the market actually moves up or down, right? One of the main concepts is understanding the difference between strong-handed traders and weak-handed traders. So strong-handed traders, generally speaking, are going to be traders that we can consider to be institutional, right? Institutional, very, very large money. Strong-handed traders, right? They take on big positions on like the sell sides, or big positions on the buy sides, and they start these very large moves. A lot of people could be thinking, okay, like supply and demand zones, but we're going a step further and actually breaking down where these big order blocks and where the actual big money is expected to come into the market. So strong-handed traders, what happens is they appear around key ledges of distributions, right? So if we can map out this as a distribution is a general volume profile term that is pretty much surrounded by a normal distribution. Right? We have a lot of videos on that. But volume profiles, right, they're split up into many different peaks and troughs, like valleys and whatnot. And these distributions that actually shape up that are like bellies, right, what they have, this is just a general drawing, what they have is areas of low volume that surround them, right? What happens is that strong-headed traders, they appear at these key ledges, or what we would call extremes. Strong-headed traders appear at extremes because it's an easy place for them to actually put on a lot of size and move the market, where they stall prices out from coming into lower volume areas, right? So they have that ability here, and they move it through the thickness of volume. These thick volume areas are low probability zones that traders would be better off not trading in, right? There's a lot of weak-handed traders that come into these. So generally speaking, one of the key distribution theory aspects is that, like, for example, here, if we just squeeze this a little, right? If we squeeze this a little, you'll see distributions a little better. Like all I'm focusing on is a 50-day profile here. So we have the top of the distribution here, right? We can have a key area here and a key area here, and also a key area where this distribution, right, roughly drawn, would start. So what happens is that strong-headed traders, right, they want to either accept or hold out of distribution. So it's going to be very difficult for prices to drop under this area where this distribution would start. So what we could consider is that strong-handed traders, right, they want to hold out the buy side for this area because it's going to be a lot easier for someone to come in, step in with size, and actually push this back into the area that has a lot more volume. So the areas that have a lot of volume, usually you get like the activity of weaker-handed traders trading there. They allow chop to happen, so on and so forth. So if we can minimize the thought process here and think about where can strong-handed traders actually appear, right? They're going to be in key ledges. So when we look at a distribution, generally speaking, within a distribution, you have a compressive period, a compressive zone where markets would range. And this happens like 70 to 80% of the time, right? We don't want to be caught in this chop because when you're in a high volume area, it's a little difficult to identify where the expansion could start or could happen. So instead, we want to find areas where we'd expect strong-handed traders to appear, which would be the key ledges that actually surround these areas that would allow us to get an edge in the market, right? These extremes are areas where strong-handed traders would appear maybe on the sell side at tops because it's easier for them to throw a lot of size on the sell side there. Maybe longs are getting in late, getting trapped into the tops, right? So it's easier for them to try to push it down towards the bottom of this distribution. So generally speaking, if we can find larger ledges, that is where we can identify that strong-handed traders could actually appear in this market to give us a better idea of where support and resistance areas actually lie based on volume, right? So even if the market, for example, right here, you can see we have a very key ledge, 82 to 84, right? When we start accepting under it, right, originally, we'd say, okay, maybe some strong-handed traders would try to hold this area, right? The first test of it, strong-handed traders move for 10 points. On the S&P 500, this is $500 a contract. So as a day trader, this is a very good opportunity. When those strong-handed traders disappear, because you can see the general trend of the market is pushing to the downside. When they disappear, these areas, what happens? They hold as strong-handed sellers that are attempting to push price down into the next key distribution block, which happens to be around this 60 region, holding for these temporary bounces. So we've just found two. All I needed was two key areas where I expect to see strong-handed traders hold. And these are the areas based on volume profile ledges, right? So if I can combine this with price action, I have a higher probability to find strong key areas instead of me just saying, okay, this was a prior low, this was a prior high, it should hold. There's logic behind as to why the area should hold, and that's the basis of actual expectancy of strong-handed or institutional larger traders actually coming into the market and sustaining those areas. So if we have that concept in mind, we can look at this chart, and what we're going to be using is a 50-day volume profile, a cumulative chart, which is here on the right-hand side, this grayed out version. And we can find key areas as support resistance regions based on distributions and distribution theory. So generally speaking, right, we can smooth over some of these distributions and identify where they start and end, or we can look at where the key ledges are, right? One here, so on and so forth, right? They're very visible. Now, another thing to notice on this is Sierra charts, by the way. And what you'll notice is that here we have some yellow numbers, right? These yellow numbers are actually very, very cool because they allow us to see where there's valleys in the distribution, meaning that where there's larger divots in the distribution, which creates the ledge. So when this ledge is created, you print this yellow line that allows you to see what the yellow pricing is. So this is a very simple tool, right? If we go into our studies on Sierra chart here, and I'll go into the 50-day volume profile, VBP 50 days, right? And I'll go into the settings. What I'm just going to do is I'm going to find line 60 something. So I'll find line 64, right? Draw peaks and valleys. So I'll just go valleys only because these valleys are those ledges that create the divots of the distributions where there's low volume. The valley creates low volume from large volume dropping off into low volume, which what constitutes a volume profile ledge. So I'll go into here, right? I'll go into the valley area. It's visible, blah, blah, blah. I'll put my labels on, make it yellow in my case, and boom, there you go. They'll print. So 82 is a large valley, right? Where I'm expecting to see strong-handed traders appear. So anything under that, we accept the distribution to the downside, and your expectancy is to see sellers appear in that area. So when I have these key regions, I can identify not only day session areas, but overnight key areas to trade, right? Generally speaking, where I can find key extremes based on distributions and the expectancy of strong-handed traders to actually appear in the market so I can get a good understanding. Now, obviously, it's not like if we have all of these key support areas, I'm buying every single dip as this thing's dumping 30 points in a single session. Right? That's not how I want to play it. I want to also understand directionality, which is another component of distributions and the general volume profile. So if I'm jumping from distribution to distribution, for example, let's say we got a big volume profile like this, like nothingness here and then one here, right? This is just a pure example. It's not necessarily the case, but we go from the top into the bottom, right? We get the expectancy that the bottom of the distribution should hold based on strong-handed buyers. Eventually, we do break and we accept to the downside into this distribution. When you go from distribution to distribution on the downside, the expectancy is sell side to actually hold out, and you get directionality from the sell side, especially if you're accepting distributions from above into below, or if you're exiting distributions to the downside. So for example here, right, we've exited a major key area from yesterday, 4,500, like 4,502, let's say. And the exit from that area to the downside puts more sell pressure in the market. And I'm just looking for rallies to sell into. Especially over here, we have another ledge around 82, 84. If we accept under that, that puts more downside pressure in the market and I'm selling rallies into it. The only reason I would look to buy this at this point is if we can actually start moving and bidding back above this 82 to accept into a distribution to the upside, which would warrant some kind of potential buy trigger. The thing with this is, right, you can look at this and say, okay, well, all these areas, they're key support, so I could fade these. The thing with fading is like you'll have like smaller moves, like 5 to 7 points, and you have to understand you're going against the trend and you're trying to get out of it. So not only will the understanding of how these volume profiles actually shape up enhance your ability to identify key support resistance areas, but also at the same time, it amplifies the expectation of direction in the market. Obviously, you're not necessarily just blindly thinking that having a bias that it has to go down or up, right? I think there should be a hint of bias, because otherwise, like, what are you doing? But I think that this gives you a general understanding of who gains strength in the directionality of the market in this circumstance. So again, to strengthen, a little review here as we wrap this up, to strengthen your support resistance areas, I don't think it's enough to have just price action. If you're going to use price action to identify these areas, understand how volume profiles and general volume actually moves the market in terms of strong-handed and weak-handed traders, because it'll open your eyes to a lot of things, right? Where precise levels are, right? Precision of levels, and what possible directionality could come out of this market. So it's a very important tool that I recommend everyone take a look at, especially if you're day trading futures on Sierra chart, because it allows you to print the valleys automatically. So it takes a little bit of the guesswork out of it. It gives you the key valleys, because you can see right here, these are about 20 points apart. Right, this is about 20 points apart. This one's about 20 points apart. So you're getting very stern key levels instead of getting every single level that's like 2-3 points apart. So with that being said, we do have a lot of videos on TradePro Academy about volume profiles, the breakdown of volume profiles, distribution theory, and how to actually use these as key metrics to trade. And I want to welcome you all to our free futures course, which the link is down below in the description, talking more about distribution theory and order flow. Also, let me know in the comments down below what you guys would like to see out of our next video. So thank you, and we'll chat soon. So I hope you guys enjoyed that volume profile breakdown of how to actually find key support resistance areas and what they mean. When you understand where these areas come from and what they're based off, they present a much higher probability of actual success. So you can combine price action and volume profiles to find those key support resistance areas, but the way I like to look at it is I'm very volume profile oriented, and you'll see that a lot of these areas are going to hold out as distribution key ledges and support resistance areas for your trades. So if you guys enjoyed this video, please hit that like button, hit that subscribe button, and I'm going to see you guys in our next video. Let me know down below what you guys would want to see.